CoreWeave stock dropped, even after a strong revenue quarter. CoreWeave, ticker CRWV. So why is the market selling it? And is this a buy the dip setup or a risk trap? The answer comes down to three things: delivery timing, cash burn from build-outs, and debt and dilution risk. Let's break it down step by step with a clear checklist at the end. Here is what I will cover today. First, the quarter results and why the headline looks strong. Second, why guidance moved down and what a powered shell delay really means. Third, the cash flow reality, including Capex spending. Fourth, the balance sheet, debt, and the convertible note risk. Fifth, the key debate about long-term returns on GPU hardware. Quick disclaimer: this is not financial advice. This is educational analysis. Let's start with what went right. CoreWeave reported Q3 revenue around $1.36 billion. That is a very large year-over-year jump. It also shows demand for AI compute is real. Companies are paying for access to high-performance compute, so the business is scaling fast. This is why bulls look at CoreWeave as a pure AI infrastructure play. But the market did not reward the past quarter. The market priced the next quarter. Now the key reason the stock fell. Management lowered full-year revenue guidance. They guided about $5.05 to $5.15 billion. The prior range was higher. When a fast-growth company cuts guidance, investors react fast, because guidance is viewed as the scoreboard for execution. Even if the explanation is a timing issue, investors still worry. They worry about repeat delays. They worry about the build-out pace. And they worry about funding needs if revenue timing shifts. So what caused the guidance cut? CoreWeave pointed to a delay from a third-party developer. The delayed item was a data center-powered shell. A powered shell is a mostly finished data center building. The basic facility work is prepared. Then CoreWeave installs the racks, networking, storage, and GPU systems. This is the stage right before new capacity becomes revenue. If the building arrives late, the install schedule slips, and the revenue tied to that capacity can shift to a later quarter. Here is the simple chain reaction: late building, late install, late capacity turned on, late customer workloads. So revenue expected in Q4 can move into Q1. CoreWeave also said two important things. They said it was not caused by a power access shortage, and they said customers agreed to adjust delivery schedules. So this sounds like timing, not demand. But in AI infrastructure, timing is the product, because customers pay when compute is available and running. Now let's define CoreWeave clearly. CoreWeave is a specialized AI cloud provider. It is built for AI workloads that need lots of GPU power. It is not trying to be a general cloud for everything. It is trying to be very good at one thing: delivering high-performance compute, fast. That focus can be a strong advantage when demand is hot, but it also creates a different risk profile than big cloud companies. The business is more hardware-heavy, and the business depends more on rapid, on-time capacity delivery. Many investors point to contracted demand. That includes backlog and what companies call RPO. Think of that as signed customer commitments scheduled over time. This supports the demand side of the story. But you must say one line clearly: backlog is not revenue. Backlog becomes revenue only when capacity is delivered and turned on. So a delay matters even if customers still want the compute. The key question is conversion. How efficiently does CoreWeave convert signed demand into active capacity and recognized revenue? This is where power becomes a key execution metric. In AI data centers, power is destiny. No power, no compute. No compute, no revenue. So for CoreWeave, the most important operational story is capacity ramp. How many megawatts are coming online? How quickly are new halls or sites being commissioned? And do timelines match what management said? When you see a guidance cut from a facility delay, it highlights this exact risk. One slip can move a lot of dollars. So investors will watch build-out milestones very closely from here. Now let's talk about cash flow, because this is where many people get confused. CoreWeave can show strong operating cash flow in a quarter and still have very negative free cash flow. That is not a contradiction. Operating cash flow can look strong due to collections and timing. Free cash flow includes Capex, meaning the cash spent on equipment and build-outs. And Capex is huge in this business. So the market question is not, is revenue growing? The market question is, can CoreWeave grow while controlling cash burn and funding risk? Here is the business reality. CoreWeave is in build mode. Build mode means heavy spending up front to install capacity. That includes GPU systems and data center equipment. The payoff is future revenue, but the timing must work. If a site is delayed, spending may still happen while revenue shifts later. That can widen cash burn in the short term. This is why the stock is sensitive to execution headlines. Not because demand vanished, because the company is walking a tight rope between speed and capital discipline. Faster expansion means more risk if anything slips. Now the balance sheet. CoreWeave reported around $1.9 billion in unrestricted cash and investments, and around $14 billion in debt. That level of leverage changes how investors think. Leverage is not automatically bad, but it increases downside if execution stumbles, because interest, repayments, and refinancing always matter. So the market will price CoreWeave like a high beta name. Strong quarters can rip higher, but any delay, any guidance cut, or any funding headline can push it lower fast. That is the trade-off with leveraged growth. Now let's talk about financing, because this is a big reason the stock moves. CoreWeave has used convertible notes. Convertibles can lower interest cost compared to traditional debt, but convertibles can create dilution if they convert into shares. So investors watch the terms closely: rate, maturity, conversion price, and the size of the offering. In late 2025, CoreWeave also raised additional capital through convertibles, and the market focused on what that could mean for dilution and leverage. Even when the company says the money supports growth, investors still price the trade-off. More liquidity, but more complexity. Another major point is customer concentration. CoreWeave has very large customers that can represent a big share of revenue. This can be positive because it validates demand, but it also concentrates risk. When a small number of customers drive revenue, schedule changes matter more. A delivery shift from one major customer can move the quarter. A ramp delay can change guidance. So investors want to see diversification over time. More customers, more use cases, more distributed revenue. If concentration remains high, the stock will stay sensitive to any customer or delivery headline. Now let's compare CoreWeave to the big cloud companies. Amazon, Microsoft, and Alphabet have scale. They also have other profit engines outside AI infrastructure, so they can fund growth with internal cash flow. CoreWeave does not have that same diversification. CoreWeave is closer to a pure play. That is why upside can be large when execution is perfect, but downside can also be larger when funding conditions tighten or delays appear. So when you value CoreWeave, do not value it like a mature cloud company. Value it like a high-growth infrastructure builder with real execution risk. That framing helps investors stay realistic. Now the long-term debate that decides everything. Unit economics. CoreWeave must earn strong returns on GPU infrastructure over time. Some critics argue AI hardware becomes economically obsolete quickly, like 2 to 3 years. If that is true, reinvestment stays high and returns compress. Others point to cases where older accelerators remain heavily utilized for years. So what should you do as an investor? Do not pick a side based on opinions. Track the evidence: utilization, pricing, margins, depreciation assumptions, and how quickly new hardware cycles change customer demand and pricing power. The numbers will tell the story. So is this a buying opportunity? Here is a disciplined way to think about it. If you believe the guidance cut is mainly a timing shift, then the dip can be an entry point. But you must treat it as higher risk. Because the company is capital intensive, and because leverage increases volatility, so position sizing matters. This is not a stock you buy like a safe index fund. This is a stock you manage. If you buy, you should decide your risk limits first. Where you add, where you cut, and what evidence would make you change your mind. Good process matters more than predictions. Here is the bullish path. The delayed facility comes online on schedule in the next quarter. Revenue reaccelerates as the Q4 to Q1 shift reverses. Capacity ramps smoothly. Megawatts come online consistently. And the company proves it can convert demand into delivered compute without repeated delays. If that happens, the market can regain confidence, and valuation can expand again, because investors will price a smoother growth curve. In that scenario, the dip can look like a temporary mispricing, but the bullish path needs proof. Not one quarter, multiple quarters of consistent delivery and improving cash discipline. Here is the bearish path. Delays repeat across other sites or partners. Revenue timing stays choppy. Capex stays high. Free cash flow stays deeply negative. And funding needs increase. That can lead to more debt, more convertibles, and more dilution risk. If the market starts to doubt the long-term returns on hardware spending, the multiple can compress fast. And when a leveraged growth stock loses multiple, the downside can be sharp. So the bear case is not AI demand disappears. The bear case is execution risk plus funding risk plus uncertain long-term unit economics. Now here is the next quarter checklist. 1. Did the delayed capacity actually come online? 2. Are new megawatts coming online on schedule? 3. Is Capex turning into revenue-generating capacity or getting stuck in build cycles? 4. Any new financing, and what are the terms and dilution risk? 5. Is customer concentration improving over time? 6. Are unit economics improving, meaning better utilization, stable pricing, and healthier margins? If these signals improve, the dip can be an opportunity. If they do not, the volatility will likely continue. If you found this useful, like and subscribe, and comment what you are watching for CRWV next quarter.